to do this. I had a chance to look at the last webcast that was done. It was quite good. You know, we have members of our board and of our investment committee that are all very curious about how Baillie is doing, what they've done to perform so well, whether there were tactical decisions that were made going into the pandemic, and now that we're out of it, or at least at the beginning stages of maybe ending this, what you're thinking, your general outlook at the new year. And I know we've talked about all these things, so I'm really excited. I've seen your attachments. I'm really excited about what we're going to hear. So this is a public meeting of the Board of Trustees and the FIAC. It's a manager update workshop for Wednesday, January 20th, 2021. We always begin by asking whether there's anyone on the call that would like to make a public comment. If there is, please identify yourself.
Yes, I would. This is Trey, Jean-Baptiste speaking. Thank you for inviting me. Director Johnson.
We're glad to have you. We've also got Renzer Bell on the call. He's working with several students. He's the head of Pension Guarantee Company, and he and I have been working to expose his students to institutional investing. I believe that Trey Jean is part of that group.
Yes.
Is there anybody else on the line that is working with Renzer Bell? I don't see anyone. I do see Gar Chung is on the line. Good to have you, Gar, on the call. And with that, I will turn this agenda over to Kevin. And Kevin, you can begin the manager update. Tell us how you'd like to conduct this.
Okay.
Well, let me just butt in for a second. Sorry, I think we might have had Trey Jean or Renzer might have had a question in the public speaking period.
Yes, I think we both have a few questions.
Andrew, do you want to just, for those who don't know me, and you just make the introduction, just kick off with that?
Yeah, sure. And just to start off with, before making introductions, to say, hopefully, as we always do when we see you, thank you very much for the continued support of the Jacksonville Police and Fire Plan and your investment in the International Growth Fund that Baillie Gifford manages. We really appreciate the long-term relationship we've got here and the conversations that we have with you when we get the chance to see you in Jacksonville or remotely. Thank you again for your sort of long-term partnership. And most of you, or many of you know Kevin and myself. We're both product specialists in the international growth strategy. We work in the client department at Baillie Gifford. We're not the portfolio construction group for the fund strategy, but we work closely with the investors. And we're delighted to talk to you about the strategy today. So in setting up this meeting, Steve and Tim gave us a bit of guidance as to what might be good to cover. And we've also received the additional questions. And thank you very much for sending those in. These calls and conversations are always much more interesting when we get questions. So before we get to the questions, our plan is to provide an update on the firm, the portfolio, and some thoughts on the market conditions, which Kevin will do. And then, as you alluded to, Tim, share some comments on how the COVID impacted portfolio activity and where we go from here. If that sounds good, and we're happy to change that, I can have a stab at the questions that were sent in. And again, thank you for doing that. I'll just pause briefly to make sure that sounds like a good plan.
That sounds like a great plan, Andrew. I'd caution everyone to put their phone mics on mute when they're not talking. Stephen is monitoring the call. If you have anything you want to mention in the chat, Stephen will recognize you. And Andrew, I'm back to you. Looking forward to it.
Great, thanks, Tim. And Trey, also thank you for the questions you sent in. We'll dive right in, and I'll do my best because they're really good questions. The first one, if I get this right, is how do we arrive at the probability of an outcome or of the outcome when we look at opportunities? You know, and this is a really important question, gets to the very heart of our investment process. And the key point here is we're very subjective in the way we look at the world. We're trying to be directionally correct about big themes as opposed to aiming for precision in the way we look at the world. And within doing that, you know, we're not trying to say there's one outcome that's going to happen. The future will hold many different possible outcomes that we can't, you know, to say which one will happen. You know, so we're not looking for a spot price. We're looking to assign probabilities to a range of different outcomes. And how do we do that? As I say, it's subjective. It's about talking to a lot of different people from a lot of different perspectives. So people from across industry, people from across academia, looking for different perspectives, and as far as possible to try and seek out geniuses, people who have real insight into these subjects, and not, you know, not assume that we step into the world with that insight to start off with. Essentially, the ideas we're trying to find are those low probability, high impact scenarios. So, you know, we're not looking for scenarios where we can be precise. We're looking for precisely the scenarios where we're quite likely to be wrong a lot of the time. So we need to make sure we don't beat ourselves up when we get things wrong, and we need to be prepared to get things wrong, to take risks, to say things internally and to clients about investment scenarios that might seem outlandish. But if those low probability events do happen, then the payoffs can be great. And as long as we're just marginally better than the market at finding those low probability, high impact scenarios, will do well for you in portfolio terms. So this is probably a slightly more creative process than most of the investment processes you might come across. And we don't spend a lot of time with spreadsheets, apart from the inevitable discounted cash flow analysis that we use in valuation. We're thinking more about creativity than spreadsheets. And when I think about the investors and how they actually put this into practice, it's really hard to generalize, because everybody deals with this in a very personalized way. And you know, they'll use their own mental models. But if I was to give you one example, my colleague Brian Lum, he likes to think about unlocking these probabilities by thinking about bottlenecks. For each specific company he's thinking about, he'll try to break it down to a granular level as to what are the key bottlenecks that company needs to get through for the blue sky scenario to be unlocked. Whether it's about cracking a bigger market share or something in their R&D process. You know, that's the thing that he focuses on. For others, it might be about, you know, the company culture and level of ambition that the management team have. But it's quite a personal, I think, a personal journey that each of the investors take in terms of coming to a range of scenarios and assigning probabilities to each of those different scenarios. I'd be fascinated to hear any of your own reflections on that if the questions come from a, you know, a specific personal experience.
Yeah, again, thank you for answering my question. I was a little confused on the low probability, high impact. Could you expound on that a little bit? What exactly did you mean by those specific?
Yeah, sure. So I suppose what we're not trying to do, we're not trying to find companies where the upside is, you know, 10, 15%, and it feels quite likely, that it feels like quite a comfortable investment. We feel quite within our comfort zone that that's going to happen. We're looking for the opposite of that. We're looking for companies where it might only be a 5% you know, scenario, the blue sky case that we're kind of hanging a hat on. But if it's only 5% scenario, but could you make 20, 30 times your money in that case? You know, I could point to Jumia as an investment case. It's an e-commerce platform in Africa where the growth potential is vast. But it might stand at quite a high possible potential of actually, you know, completely failing and going bankrupt. So you've got this, you know, tail scenario of losing 100% of your money, but you could make 20 or 30 times your money. Now that's a really uncomfortable place to be when you're talking to a client about an investment that's got a high probability of failing. But if you've got a collection of these investments in a portfolio and you only need a small handful of them to really pay off, that's what's going to drive portfolio outcomes. So we're looking for these sort of low probability scenarios where the payoff is exceptionally high. If the risk reward payoff is high enough, it's worth investing in those companies.
So, and is there anything you do to mitigate some of that risk for maybe your entire portfolio? isn't so risky?
Yeah, I mean, I gave that example as maybe demonstrative of the extreme case. It isn't that the case that all the portfolio holdings are like that. We have a range of sort of risk payoff scenarios in the portfolio. One way to describe this is companies that are adapter type companies that are maybe more established businesses that are just growing very well within their mature business areas. And that's half the portfolio. And then you've got another half which are more disruptive, innovative, I guess disruptor is a well-used word, that are these high growth, maybe higher payoff scenarios. And essentially that comes, what I'm talking about here is diversification across business model types, across the kind of bets we're taking, but also across geographically, across sectors, and across the kind of underlying business models that we're investing behind. So, risk management is essentially around diversification.
Yeah. Let's just be clear here. We are trying to construct a diversified portfolio of high growth companies for our clients, and with just over 50 holdings in the portfolio, we believe that does provide diversification required. But we're also, as Andrew said, increasingly, and over the decade plus that the Jacksonville Police and Fire have been with Baillie Gifford, we've increasingly been interested in the growth of the capital G, if you like, the higher growth end of the growth spectrum, which we tend to refer to as disruptors. So the portfolio shifted over the years towards that part of the market. But in overall portfolio terms, diversification is there, and it's important.
Thank you.
If there's any more, we'd be delighted to keep talking about that topic. We could move to the second question if it's appropriate.
Okay.
So does a platykurtic distribution of potential outcomes for a given opportunity change the investment methodology? I think what we're talking about here is, in terms of distributions, this distribution you've referred to is one where I guess the peak of the distribution curve is slightly flatter, and the tails are slightly fatter in terms of curves. And again, this gets to the heart of the way we think about stocks and markets and opportunities. I think the short answer is no. We try to approach every stock in the same way. Our research process is very similar. We ask the same 10 questions, and we apply the same logic to companies. So that the short answer would be no. But the interesting nuance here is, we've got a very strong belief that the market underestimates the skew that exists in the distribution of returns for stocks specifically, but also at the market level. So, everybody knows that it's common knowledge that for stocks, you're investing in a scenario where you've got potentially unlimited upside, but you can still lose 100% of your money. But unlimited upside is, it's a much bigger multiplication than just 100 times downside, 100% downside. So that's common knowledge, but we don't think many investors really exploit that fact or really take that observation to its logical conclusions. So when it comes to thinking about the distribution of returns, we're looking for stocks where the market is underestimating the extent of the right tail scenario. And we think there are lots of companies out there where if everything goes right, the blue sky is huge. And that leads us away from, the utilities of the world, the traditional energy companies of the world, where, the range of outcomes is relatively narrow, and towards companies where the range of outcomes is much more distributed and the right tail can be extreme. So yeah, distributions are very important to us, but we don't think about it in kind of platykurtic or the height of the peak. We just think about the extent of the right tail, because we know the left tail, the downside tail, is always capped at 100% downside.
Okay, thank you.
And then the last question, which is really interesting, because energy transition is something that we are really getting much more excited about in recent years. You've asked about whether the reaction of the Seven Sisters, and I think that means the traditionally dominant oil and gas companies to the energy transition has been to invest greater stakes in sort of renewables or EV companies within their portfolios. we think that that transition you're referring to is really important and will be one of the big themes for us over the next 10, 20, 30 years. Energy is a huge sector across society, and it's about to, pivot for possibly only the third time in our history as we move out of the oil and gas sort of age into the renewable age. But when we think about that, we really haven't been focusing our attention on traditional oil and gas companies. We think that so much of their balance sheet is tied to assets that could become stranded. So we're looking for companies that can be transformative and grow rapidly. We don't think looking at companies where they've got a balance sheet that's tied to the part of the energy market that we're moving away from is sensible from a growth investor's point of view. There might well be good investments there from a different investment style. But when we're looking for growth companies, we're looking at battery manufacturers, we're looking at electric car companies, we're looking at companies in the supply chains that will support the renewable energy infrastructure. We haven't got many of those holdings yet, but there are a few in the portfolio. There's an increasing amount of research attention going there, but it's not pointing towards the Seven Sisters traditional oil and gas companies. But again, we think this is a fascinating topic. So if you've got any of your own perspectives, we'll be delighted to hear them.
Well, I just thought that, given their size, the views of, how the Seven Sisters are moving forward, given that we're going through this transition, might influence your decisions for, perhaps the aggressiveness that you're pursuing these opportunities. But it does make sense that since they're, kind of being phased out, that perhaps they're not the leading on this conversation. So it makes a lot of sense.
Yeah, no, they're big players in the way the world will shift. I suppose it's interesting to add a bit of context to the way we are allowed to think about the world. As Kevin said, we only have 54 odd stocks in the portfolio right now. Our active share is 90%. So having a small number of stocks that are very different from the index means that we can have the luxury of being able to kind of ignore large parts of the market that we don't think are that interesting from a growth point of view. We haven't owned any oil and gas companies for at least 5 years, possibly a bit longer than that. So we're able to sort of step aside from parts of the market that we don't think are aligned with our growth mindset. So there will be very important parts of the transition, but from our point of view as a growth investor at this stage, they're not that exciting.
Has the recent success of Tesla impacted that at all? Maybe on the other end?
Yeah, for full disclosure, Baillie Gifford is a very large investor in Tesla and has been for a pretty long time. So we do have a view on Tesla and the success that Tesla's had, and the insights we have from that relationship with Tesla has given us confidence about the speed of the transition in certain parts of the renewables industry. We own other electric car companies. In this portfolio, we own a Chinese EV company called NIO. So I think the depth of our knowledge, research, and the confidence we've gained has kind of spurred some of the ongoing research and the excitement we've got for the future in this space. And also the confidence that we've got that this transition is going to be pretty rapid over the next 10 years. So Tesla has had an impact, and we've been very close to Tesla during its journey over the last decade.
Okay. Thank you.
Thank you for sending those questions in. If it's okay, Trey, Steve, and Tim, I can kind of continue with the presentation and the slides, if that's helpful. So well, on that point, I'd actually hand over to Kevin to talk about the firm and the portfolio.
Yeah, thanks, Andrew, and again, a formal good morning to everybody. Hopefully you've got the presentation pack that we sent visible to you. And I'm just going to give you a brief update on Baillie Gifford and the portfolio returns and how the portfolio is shaping up at the moment. And Tim, I think as Andrew and I go through this, hopefully that will cover all the issues that you raised at the start of this session. This is on slide 1, just the developments of Baillie Gifford. It has been in the fortunate position of being well placed to withstand the coronavirus crisis, both operationally and from an investment point of view. Operationally, prior to this virus breaking out, what, a year ago now, goodness, hard to believe a year has gone by, but anyway, it has. Prior to that point, we had spent the previous 18 months, 2 years investing quite a lot in the technology to allow us to work more flexibly, including working from home. And that has stood us in good stead over the last year. We're still working from home, as I noted a few minutes ago, and we've got a few people in the office who are literally turning the lights on and off and making sure it still exists. But apart from that, government restrictions up here mean that we have to work from home. Fortunately, with the technology that we've got, the laptops that we've got and stuff, platforms like that we're on just now and WebEx and so on and so forth, we're able to interact with our clients pretty seamlessly. So operationally, it's fine. All the key business functions are operating normally. And from an investment point of view, it's obviously, as you will have noticed, I'm sure, been an incredibly strong period, both for the strategy that you're invested in and, in fact, in nearly all Baillie Gifford strategies. So that has been good news for us. That, in fact, is one of the reasons why we have reclosed the international growth strategy to separate account inquiries. The recovery in the market and the extent of the outperformance means that the size of the strategy is now just under $80 billion US at the end of the year. And so we've taken the view that, looking forward in our usual cautious capacity manner, that we will close to new separate accounts to enable us to continue to manage the portfolio in the way that you've become accustomed. It's much more operationally difficult to close a fund, such as the mutual fund in which you're invested, so we haven't done that. The business continues to invest for the future. As you probably recall, each year we have an investment graduate round, and this year the quality of the candidates was such that we took on 13 new investment graduates, which is a higher number than normal. Normally it's 7, 8, 9, 10, something like that. One of those graduates has found his way into the international growth team, so the team that manages your money, a chap called Douglas Jack, and he will rotate off after 1 year and be replaced by another trainee graduate. And that's the normal way we operate. Trainees rotate around individual teams for 5 years before they're placed in one team on a permanent basis. And then we don't often talk about other strategies, but just want to point out 2 strategies. One is called the Health Innovation Fund, and this is something that healthcare, the broad trends in healthcare markets, is something that we've talked about on a number of occasions when we've seen you in Jacksonville, and indeed your portfolio has now building up a decent presence in the healthcare market. And we've been incubating a fund called the Health Innovation Fund for some time. It's now open to external clients, and we're pleased to say we've got our first external client on board there. It's still a small fund, only about 340 million in total in the strategy, but we hope over the years that will grow. And then finally, a really interesting development. We've been investing in private companies since 2012, and that was the first one was in Alibaba. And we've now got about $5 billion in private companies across a range of Baillie Gifford clients, and we are in the early stages of launching a GPLP structure in the US that we hope many of our clients will be interested in, and Tim and Steve, we would very much hope to have a conversation with you about that. So maybe in due course we'll be in touch and see if we can fix up a conversation if that's something you may be interested in. So the broad picture of all that is that things have been going well at Baillie Gifford, and that's good news for us all. If you go to the next slide, just a brief comment on investment returns. It's not something we normally talk about, to be honest, but obviously 2020 was a fairly extraordinary year, so it's worthwhile just dwelling on that a little. And I think the extent of the outperformance, 50% outperformance, it really speaks to the portfolio positioning going into the crisis. And just as a reminder, that was based on three broad tenets. The first one was the power of technology and the increasing power of technology to impact a whole variety of sectors, healthcare being one, which we just mentioned. So that's one. The second was the ongoing rise of China, which we believe will continue, and we believe the Chinese capital markets will develop substantially over the next 10, 20, 30 years as well. So tech and China, and also the focus on a small number of well-managed, well-financed companies when it comes to portfolio construction. So that's the way the portfolio was positioned going into the crisis, and those ideas have been in place for some time, and they've obviously stood us and you in very good stead over the 12 months since the crisis broke. And if you just look at the bottom left-hand slide of this side of the slide, you can see that a little table with the top and bottom 5 relative contributors over 1 year. And the top 5 contributors there are all digital economy, for want of a better word, digital economy stocks in one way or the other. M3 is a Japanese-based online medical platform, Mercado Libre, Latin American e-commerce platform, Meituan Dianping, Chinese delivery stock. ASML makes the absolutely key equipment for the manufacture of semiconductors, and Zalando is a European online fashion stock. So all absolutely integral to the development of the digital economy. And Tim, you said that you'd listened into a recent webcast, and clearly, where do we go from here is one of the key things on our minds, and we can having done so well, and we can come to that in due course as we go through the presentation. On the next slide, you can see the portfolio. And as per usual, we've divided it up by holding period. Over 10 years, 5 to 10 years, 2 to 5 years, and under 2 years. And you can see that now the two left-hand columns, over 60% of the portfolio has been held for more than 5 years, and over 20% for more than 10 years. So this is long-termism in action, and we would hope as the strategy evolves that those numbers will increase a little more. So it's a genuine long-term strategy. If there's a key message to leave you with on this slide, it's that we remain, and it plays into where do we go from here, it's that we remain very happy with the aggregate operating performance of the portfolio. Seeing some very strong growth in revenues and profits. And equally excitingly, we're very happy with the opportunity set. We think there's a long duration opportunity set for many of these companies, and that the coronavirus crisis has clearly accelerated trends that were in place anyway. And one of the key things we're doing at the moment is going through each stock line by line to try and assess whether, how that will shape up in future. Is it just demand brought forward, or has there been a sustainable acceleration in demand? And that's a key part of our thinking around stocks just now. I don't want to talk about transactions in too much detail, but just notice on the right-hand side, there's 3 stocks with a little green blob next to them. Those are 3 new purchases, all Australian stocks, interestingly. Afterpay is a financial stock, and WiseTech Global and Xero are both enterprise software stocks. So we think all those names there have interesting growth prospects going forward. So happy with the portfolio, happy with the opportunity set. And just before I hand over to Andrew, just further to the opportunity set on page 4, you've seen this, or many of you have seen this chart before. We call it our portfolio insights, or bubbles, for want of a better word. And this is really giving you a feel for what are the where the opportunity set lies, and where we think the sort of growth drivers of the portfolio lie. So it's not about countries, it's not about sectors, it's about the broad trends that are going to generate growth in the world going forward. So let me just note 2 of the bubbles. the little light blue one at the top, health innovation. There's a number of stocks in your portfolio that play directly into the advances we're seeing in healthcare across the world. And we expect that bubble to grow over time. And then maybe on the right-hand side, China is special. There's clearly a lot of debate around China at the moment in various ways, but we think that the rise of the Chinese economy, or the reshaping of the Chinese economy towards the consumer, is going to be fairly inexorable, and that is giving rise to and will give rise to plenty of investment opportunities in future. So this bubble chart here is giving you a representation, if you like, of the key underlying growth drivers, what's really matters to your portfolio, and also a sense of the diversification in the portfolio, to revert to an earlier question around that topic. I'll stop there. Happy to take any questions about any of that. Otherwise, I can hand over to Andrew.
Okay. Yeah. Okay, if there's no questions, I'll just thinking back, Tim, to the way you opened the meeting, and thank you for sort of framing it. You asked the question, thinking about last year in 2020 being so eventful, did we make any tactical changes going into the crisis during the year? Stocks were up and down. Do we make any changes then? And then as we are now, how do things look going forward? If I can just sort of press play and sort of canter through that experience, hopefully it'll be helpful. You might have seen a couple of these slides before, but I'll try and keep it very high level. But I think the key message in all this is, Baillie Gifford is very long term. We try to look through noise where we think it's sensible and where we don't think we can add value, and that's basically what we did. We obviously did a lot of work to try and understand things, but there hasn't been any major upheaval, as Kevin pointed to in the portfolio. Annual turnover over the last year was 9.4%. That's sort of bang in the middle of the range we'd normally have in any other normal year. But that obviously masks a lot of analysis and thinking. But where we don't have a strong conviction, our thesis is to be long term and stick to our guns. And I'll show you why we think that made sense. So going back to March, if we could skip to the next slide, which I think is entitled Portfolio Resilience. Going back to March last year, when the crisis was erupting, one of the first things we did was to quickly look at the portfolio resilience and look for any vulnerabilities in the portfolio. And again, we may have discussed this slide with you, last year, shortly after we'd undertaken this work. But what we did was look at the portfolio across two axes. The vertical axis is financial resilience. So companies high on that axis had strong balance sheets with little debt. Many of them had net cash. If companies are lower down on that axis, they'll have a more geared balance sheet. And on the horizontal axis, we were looking for business models that would be, how they would be affected by the crisis. So being on the right-hand side means your business model might actually benefit from the crisis, from the lockdowns. Being on the left-hand side, your business model would be affected. So the affected business models would be those, for example, exposed to the travel sector. So you had Rolls-Royce, the jet engine manufacturer down there. There's also a number of car manufacturing companies where the supply chain was disrupted down there, and they also had geared balance sheets. So the reason why we were quite confident going into the crisis about portfolio positioning, and the reason why there wasn't a lot of turnover, was because of the skew in the portfolio, as you can see, towards the top right. The bigger bubbles, and they represent the size of the portfolio exposures, are towards the top right of the chart rather than the bottom left. That's not to say we didn't make some changes. Aston Martin, which is down there in the bottom left, was sold very early in the crisis because of the state of its balance sheet. And we did a lot of work on Rolls-Royce through the year to make sure we were comfortable with that position. But that was the initial reaction, and there wasn't a lot of activity, but that wasn't because we weren't thinking carefully about things. The other thing to think about here is the research activity. How does our research work in a lockdown world? For existing positions, this has been fine. We've not had the opportunity to travel, but there's been a lot more Zoom, and the management teams we want to speak to are generally available. They're not jet setting around the world either, and there's a lot to talk about. So we've had a lot of good time, a lot of valuable time talking to management teams remotely, and that's given us plenty of inputs for your existing holdings. It's worth acknowledging, though, that it's been a bit more tricky when it comes to new ideas. We try to be creative with new ideas, and that's harder if we're stuck at home. We would normally travel a lot, And the objective when we travel isn't to go and meet 1,000 companies, it's to go and speak to interesting people and often have conversations whilst we're on a trip that we weren't intending to have when we first took off. And serendipity plays a part of that. So it's been more challenging to do that work remotely, but we're obviously learning new ways of doing things, attending conferences that are being hosted virtually, and the like. So we're working through that, and we still come up with a good number of good new ideas in the portfolio over the last year, and we're comfortable where we are. We'd obviously like to be traveling again. But I referenced the portfolio check as one kind of key piece of analysis we did. Because the portfolio was well positioned and we saw performance of numbers of stocks do very well, we also had to sense check the remaining upside for stocks that performed very strongly. Maybe we could sort of switch to the next slide briefly, which is entitled Acceleration in E-commerce. I just want to show this slide to demonstrate why some of the stocks in the portfolio performed as well as they did. As Kevin pointed out, a lot of the stocks in the portfolio are geared towards online businesses. And we're showing some data here around e-commerce penetration and how that changed during the crisis. We've shown the UK and US data just as proxies for what was going on around the world in that first chart there. And you can see there's been a long, steady, slow and gradual increase in e-commerce penetration in both markets. But that jumped up dramatically during the period of the first lockdowns. And it was that rapid increase in e-commerce penetration rates that was driving the growth of companies like Meituan in China and Mercado Libre in Latin America and so many other portfolios with related business models. We don't expect those changes to stick forever in their full sense. Obviously, when the lockdowns come to an end, we will all want to go back to restaurants and shops again. But some of these changes will stick because new habits have been formed and because these businesses have achieved a scale where they start to benefit from better economics. So we saw this rapid increase in e-commerce penetration and also a rapid growth in, for example, in healthcare, in the solving of, the idea that we could create a vaccine for COVID in less than a year would have seemed impossible and outlandish a couple of years ago, but it was achieved through the miracle of gene sequencing and new biotech techniques. So these sort of breakthroughs led to dramatic changes in the share prices for numbers of companies in your portfolio. For example, just to name a few, HelloFresh, M3, Mercado Libre, and Meituan Dianping all roughly tripled during 2020. And we had to take account of these dramatic share price movements and go back to the investment cases in those stocks and make sure there was still enough upside available in those holdings to justify their positions in the portfolio. And when we did that work, we were testing two things really. One, the remaining upside value that could be achieved in the business models, and also the probability or how likely those upsides are to be achieved. And in almost all cases for these e-commerce platforms, we continue to see enough in the blue sky case and enough reasons to continue holding them that we haven't really sold any of those sort of e-commerce platforms, as it were. One stock that really fell foul of that analysis was SoftBank, where the share price had appreciated quite significantly during the year. And we started to become quite concerned about the culture that was evolving in the firm. So we haven't completely sold out SoftBank, but we've reduced the position quite substantially. And then the share prices continue to grow. But it's been a source of funds for other ideas elsewhere in the portfolio. So a mix of outcomes, but broadly speaking, we remain very comfortable with the stocks that we hold and the remaining upside there in spite of the strong performance that's been achieved so far. I'll pause there because I'd like to go on to sort of what we see in the future and where we go from here. But any questions about performance over the year, what happened last year, or any of your own observations in terms of the plan overall? It'd be fascinating to hear your own thoughts.
Andrew, this is Rodney Van Pelt with the FIAC committee. And I was just interested in the e-commerce penetration graph. Could you explain that a little bit, like the calculation and why there's such a margin between like UK and USA?
Yeah. So this data comes from the US Department of Commerce in the US and the UK Office of National Statistics, and these are the best. You can get a million different definitions of excluding gasoline sales and groceries and things, but this seems to be the most appropriate generic expression of the amount of total retail sales in each country. So it's retail to individual consumers, not industry, and total retail. The UK is, and I don't know the underlying reasons for this, but the UK is globally a sort of leader in terms of e-commerce penetration. We perhaps just more lazy in terms of not wanting to go to shops. So for whatever reason, the UK is way ahead of all of Europe, way ahead of the US, as you can see. Not ahead of China, I don't think, and I don't have the data for that. I think China's also got very high penetration rates, but it's just total retail percentage that's online. And in the UK, the uptick you're seeing that's occurred last year and recently, I think the difference in the rate of the spike is probably to do with the severity of the lockdowns. So, in the UK at the start, it's in spring last year, we were effectively banned from going into all shops apart from supermarkets, and even then, pensioners were or elderly folk had more privileged access to supermarkets than the rest of society, and that's the case again. Basically, all shops are closed now, even for click and collect scenarios. So I think that's probably the reason behind the different movements you've seen during the crisis between the two countries. But the starting point was already the UK having a higher penetration than the US, and they're just proxies. I think from an international investor's point of view, the portfolio is leaning into that picture in Europe and across Asia. So, and each country will have a slightly different level of exposure. I just to expand on that point, if I may, I find the second chart quite exciting as well, which is a projection of where we go from here after baking in what happened in 2020 in terms of the growth rate in e-commerce penetration, what each of these markets look like in terms of future compound average growth rates in e-commerce spend. And for us, we talk a lot about China. I know China is very topical right now for a number of different reasons, but one of the reasons why we're so excited about China is two points. One, the vast scale of the online market that already exists, and two, the rate of growth at which it's going to compound that. So 9% compound average growth rate on that size of market is a huge sort of growth opportunity for the companies that are in that space. So the second chart really talks to why we think it's worth holding on to these companies, even though the share price has gone up quite a lot, because that growth runway is still there. These are external projections, not Baillie Gifford's, but there's a real conviction that e-commerce penetration is going to keep going up in spite of what's happened over the last year. Is that helpful?
Yes, that was helpful. I was on mute, I'm sorry. I'm really shocked that, living in this shutdown environment and watching the growth of like Amazon sales and Target, all these online and groceries, and we only moved as much as we did in the US. It's a low number to me, it seems low. It is what it is.
Yeah, so that number comes out quarterly as opposed to the UK number, which is monthly, and I expect to see that tick up again when the December number comes out, but that's not available yet. I think it might change direction again. We'll see. So with that being said, I think the interesting point that Tim raised at the start was, where do we go from here? How are we thinking about portfolio positioning, and what are the exciting themes that we're spending more time researching? And I'd maybe highlight three kind of factors that have come out over the last year or so for us strongly. And the first is the point that Trey helpfully mentioned right at the outset, this energy transition, and the fact that we're moving towards an era of renewable energy generation from distributed sources that will yield much cheaper energy to both industry and consumers. There were huge gyrations in the price of oil over the last year, but if you put all that to the side, as an exceptional year, there's nevertheless a very steady trend towards being towards cheaper and cheaper sources of renewable energy that are becoming ever more cost competitive. We think that trend will continue for over the coming decades, and it will lead to an inevitable scenario where our energy comes from renewable sources, and less industries rely on oil. Because of the size of the energy industry globally, that's going to have profound consequences for stock markets and for company opportunities. And it's our job to really unearth where those investment opportunities lie in a growth sense for our clients. So we're spending a lot of time thinking carefully about what the implications are, not just in terms of traditional energy companies, but what does it mean for all companies if energy costs are dramatically lower? If for example, Atlas Copco, which is a Swedish engineering company that produces compressors that are used around the world, one of its USPs is that its compressors are so much more cost effective and use less fuel and are cheaper to run than those of other companies. But if energy becomes almost free, very cheap, that USP goes away. So how does this energy transition translate for companies in energy sectors and outside energy sectors is something that's really exciting. We're doing a lot of work in China, looking at the battery industries over there to try and understand how this opportunity will play out in China, because China is leading the world in electric vehicles. So that seems to be a logical place to start this work. And I think I'm confident that we'll be talking to you about energy more in the future than we have in the past. The second area I'd say that we are increasingly excited about, and again, Kevin mentioned this, is healthcare, which is being revolutionized by data. We're optimistic about the opportunities here because of the sort of convergence of genomics with computer science. So we've got this ability now to sequence human bodies and diseases rapidly and quickly, and the ability to analyze data on these diseases in a way we couldn't have done before. And part of that's to do with artificial intelligence. I mentioned the COVID vaccine that we invented in less than a year earlier on, and that could be the sort of canary in the coal mine. If the biotech industry can do that with one vaccine, imagine what we could be doing in future years when that becomes sort of the normal rate of progress. So we think that the whole health industry is set for a lot of disruption, and we want the portfolio to be positioned to benefit from that going forward. We're already overweight for you in healthcare. We think that will continue to be the case over the long term. And then the third and final area I think is worth highlighting is the ability for these internet companies that we've talked about at length to succeed in the face of the sort of mega platforms. We've long held positions in companies like Mercado Libre and Zalando, but we've often been quite timid in the weight we've given them in the portfolio, because we've always worried about Amazon in the USA crushing Mercado Libre in Latin America. That's always been a massive risk for us. Or Alibaba in China crushing Meituan Dianping as an upstart internet platform in China. And that's always been a reason for us to be fearful and not have a bigger weight for those positions in the portfolio. But last year, and indeed from before, we've seen Mercado Libre succeed. And last year, its growth rates were phenomenal. It's now got the scale where it could actually mount a significant defense against Amazon. So we think the risk of Amazon, squashing that company has gone down significantly. Likewise, in China, Meituan Dianping has turned a profit for the first time in the face of an onslaught of competition from a much larger rival in Alibaba. And those two examples, you could play out that story in lots of different other companies. For example, Zalando in online fashion in Europe. We've now got much more conviction that tier 2 internet platforms that are operating in smaller niche areas can and will survive and thrive despite these big mega platforms, the Facebooks and Googles of the world existing around them. So that's another area I think our conviction has changed slightly on, and that will have a meaningful impact in the way that we position your portfolio going forward. And I'd stop there because we obviously could get into loads of stocks and nuances in specific areas, but I think they're the three most interesting themes that we're excited about coming out of 2020. Tim, I'm keen to make sure we've answered your question that you posed at the start of the meeting. I'm also really keen to hear how things have been for you all in terms of the plan and the plan returns and your expectations and your thoughts for the future in terms of the the way you're looking at the overall plan and fund.
Sure, I appreciate the presentation. Before we get into that, I wanted to ask about cryptocurrency and what Baillie as a firm is thinking about that asset.
Maybe I'll start. We have not invested in any cryptocurrencies. As far as I'm aware, we have no intention of investing in any cryptocurrencies, and just occasionally having a look at the business channels, seeing Bitcoin go up, $5,000 a day, whatever it is. It's kind of extraordinary stuff. So, I think until one can have a more fully formed view on what actually the asset is and why people are buying it, then I think it's in other words, a fuller understanding of the marketplace, and I think it's not one to get involved in. I think the underlying technology may be interesting, however, the blockchain technology, and I know we've written a couple of research papers on that in the past and how that might impact a range of industries. Our own industry, for example, blockchain has as I understand it, the ability to provide instant share settlement, for example, so it could materially shorten the settlement cycle to virtually instantaneous. So whether that happens or not, who knows? But things like that, I think, are interesting. But we're not investing in the cryptocurrencies per se. So Tim, you're on mute, I think.
I am. I apologize for that, Kevin. I get so used to going to mute when I'm not talking, I forget
I do the same.
Turn it back on. Can I, am I coming through okay?
Absolutely.
Very good, very good. So part of that investment strategy, right, is not only to select great companies and stay the course, but also to get in early so that you're able to enjoy some of that incredible upside. Are there other companies that are on the horizon that you could give us some hint about that the firm is looking into?
Yeah, I think, yeah, that's an interesting question. One stock that we're looking at quite closely, in fact, we discussed it at our research meeting yesterday, is a Chinese battery provider called CATL or CATL. And this is a battery provider to the EV, electric vehicle industry in China, which, as you may know, is growing rapidly at the behest of government who have got demanding targets in place for the number of electric vehicles on the road as a proportion of the Chinese car fleet over the next decade or so. So we expect that marketplace to grow very substantially. CATL itself is not the only player in the market. You've got a Korean company called LG Chem that's also in China. But we think this one has a chance of becoming the national champion, if you like. So that's one we're looking at pretty closely and is kind of, whether it gets into the portfolio or not, I really don't know, but that was discussed yesterday. Another one is BYD, another Chinese battery oblique electric car manufacturer. So yeah, there's a number of ideas. We've been pretty pleased with the level of idea generation. So that's encouraging. Competition for capital for space in the portfolio is quite demanding. So the bar is high to get into the portfolio in the first place. So there's lots going on in the background, and that's pleasing.
I do. I appreciate that. So, if you've kept an eye on our website, Stephen is our recording secretary, does an outstanding job of giving great detail on not only what we're doing meeting to meeting, but also what the work plan is for the board and the investment committee for the months to come. you know that at the end of last calendar year, we added alternative assets to the allocation. We're looking at 8% private credit and 5% non-core real estate. And over the next 60 days, we're going to kind of build out that private credit strategy, kind of dig a little deeper into the asset class, put together some recommendations about how we're going to pace those investments, the size of those investments, and a selection process for those managers. So I think that's going to be the most exciting thing we do in 2021. We're going to begin with the private credit asset. And then after we get that under our belt, at least in terms of a plan of action, we're going to do the same exercise for non-core real estate. So it's a lot of money. I mean, we're probably looking at $250 million that we'll be investing over the next 3 or 4 years. So it's going to be exciting to move forward and see how that impacts the fund long term. It's really the first allocation work we've done since I've been here. You know, this portfolio has been very stable, very consistent in terms of the managers that are in it for a long time. We had one manager that left the portfolio the first 18 months I was here, and we reallocated those funds to an existing manager. So this is going to be an exciting time where we're looking at both 2 asset classes and, you know, allocating money potentially to new managers over the next few years.
So that's really interesting, Tim. And I mean, firstly, I absolutely, in relation to the website, we do indeed go on it periodically, and it's full of information. It's tremendous, you know, minutes and everything, and all sorts of stuff. So, Steve, totally agree with Tim's comments there. It's absolutely brilliant. And of course, we were last June. We were on the call when RVK were present, and I remember, you know, staying on the call as they were discussing your sort of asset allocation study they were doing. So, is it fair to say that this allocation process that you have in mind, is that a direct result of that RVK study, or is it? Yeah.
Yeah, it's a direct result. Am I still coming through? Yeah, it is a direct result of the work that RVK has done.
Thank you for that insight.
I don't want to dominate the conversation or the questions. We have you until 11. And if there's anyone else that's got a question they want to ask, let's give them that opportunity before we wrap up.
I have a quick question for Andrew and Kevin. What's the biggest challenge you think Tesla is going to face in the next short term, 1 to 2 years?
Crikey. Andrew and I are looking at each other thinking, go first. So, wow. Well, I guess. I mean, the word that springs to mind is, for me, is in that they're now up to what, about 500,000 vehicles a year, just under that, I think. Is that right? Yeah, I think it's just under that. And clearly, they have ambitions, you know, to deliver well beyond that number. And there's obviously to ramp up production, to be multi, of 500,000 cars, obviously is a huge operational challenge, not just in the USA, but around the world, with the Chinese factory up and running, and they're building the Berlin gigafactory as well. And so that's, to me, I think it's the operational side of things. I think Tesla now has got itself into a position where, if you'd asked me the question a year ago, I might have said, well, there's financial issues around Tesla, but of course the way the share price has gone and the way they've been able to take advantage of that in terms of capital raising and getting the balance sheet in order means that I think that the financial balance sheet risk to Tesla is, just, nowhere near the extent that it was in time gone by. Meanwhile, I think it's well accepted that their cars are good. They're ahead of the competition. People like them. Volumes, execution has been getting better. So I think it's around operational issues for me. Andrew, have you got anything to add to that?
No, I'd agree. I mean, I guess where my mind went was batteries and the kind of next phase, the next leg of the growth. It feels like they've got tailwinds behind their ability to, the favorability of the brand and the success in China and Europe and US with sales, but they're also very ambitiously about ambitions around developing their battery and capabilities internally and building that out. So that feels like something that they need to crack and will be a challenge, no doubt. So that looms ahead for them in terms of the business success and the share price success as well.
How does that? Do you have any? Does that resonate with you, or would you agree or disagree with that?
Oh yeah, thanks guys. I've sort of thought the same thing, about the battery technology and their growth. It just seems like there's nothing standing in their way, and they've just made such great progress last year.
Yeah, it's been extraordinary.
Extraordinary to watch.
I have a question, if I may.
Sure.
Please.
Go ahead, Renzo.
Are the Seven Sisters taking this line down? I mean, are they just going to say, okay, the energy, a certain percentage of hydrocarbons will be used for transportation? Are they just going to say, well, we're just going to be phased out? Are they fighting back? That's why the question was posed with respect to them investing or seeding companies like this as a hedge to their position. Because historically, they've always, they did things in the 70s or 60s, like somebody come up with a really sharp idea on a carburetor that would be, or fuel injection that would be highly fuel efficient. They bought they would buy the rights to it and just put it on the shelf. So are they going to take this line down, or are they going to fight back in some way? Or what are you seeing at this point?
Yeah, well, I mean, I think as Andrew noted, I mean, I can't speak with any intimate knowledge of these companies. We haven't invested in the sort of oil majors, if you like, if we can refer to that, for a number of years. It would not be unusual for major, and I think you can see it in this country, just even something as straightforward as the advertising on the television, that, they're all trying to get into the sort of cleaner part of the energy industry. And it would not be unusual for major incumbents to indulge in some corporate activity to access parts of the market that they're going to find perhaps difficult to access organically because of their existing size, because of their legacy costs, because of institutional sclerosis, these sorts of things. So, yeah, I mean, I think we would expect them to get involved in the competitive nature of the market to be quite fierce. But renewable energy, as Andrew noted earlier, covers a multitude of areas and a multitude of sectors and a multitude of companies. So, I don't think that reduces our confidence in being able to find growth companies that will be able to thrive in that sort of environment. Is that fair?
Yeah, I think that another way of thinking about this is that there might be the problem with the big oil companies from a growth investor's point of view is that they might well acquire a handful of really exciting, disruptive, innovative in this renewable space, but they quite often will be so small as individual companies that they won't really turn the needle for this massive oil and gas major in terms of its overall, EBITDA performance over the coming decade. We could invest in a $5 billion market cap, disruptive energy company, and it could double or treble and be a brilliant investment for us as growth investors. But if that company or a dozen of those companies was bought by a Shell or an Exxon, it's not really going to move the dial for those companies in terms of the the top line or the operating profit for those companies from an investor's point of view. So we're more interested in trying to take direct investments in rapid growth companies or growth companies in this space, rather than thinking about how an acquisition or a dozen acquisitions by an Exxon or a Shell might change their look and feel, because we want to hold these growth companies directly rather than through some massive conglomerate. And I guess that's how we think about it. And it might well be true. I'm sure you're right that they will invest in these in different technologies and spaces, but it's just not exciting for us, because we don't think that those investments will have a big impact for us if we were a shareholder in BP, for example.
I wanted to thank you, Andrew and Kevin, for a great presentation, and thank everybody who's on the call. We have an 11:15 Zoom call to get on, so we have to cut this one at this point. But congratulations on a good year for Baillie. We're certainly grateful. And I hope that 2021 is as good or better.
So, thank you, Tim. Thank you, everybody, for your attention. And I'll pass that message on to the investors, Tim.
All right. Everybody take care.
Thanks. Bye.
Thank you.
Bye now.
Thank you.